Hi, everyone. Derek Schwartz, host of the Advisor Lab. On today's episode, our guest is Larry McDonald. Larry is a New York Times best-selling author and the founder of the Bear Traps Report. Yeah, thank you for coming on the show. And it was interesting because I was just reading Barron's last weekend, and I saw you were quoted by in the up and down Wall Street piece from, I believe, Barry Levinson.
Yeah,
And
Barry.
I was reading a few of your quotes just about how there needs to be a reset on earnings for the S&P, and that the analysts are they were talking about that, and you had mentioned a couple things about this is very similar to the overinvestment in energy that we saw that didn't really materialize, and we had kind of the lost decade of returns in the S&P. I know we had a book come out a year ago, how to listen when markets speak. So I thought it'd be a really good idea. And then who knew the market kind of melts down yesterday.
Yeah. Oh,
And
yeah.
it looks like we're facing more punishment. So why don't we do this? Maybe you could share just a little bit about your thoughts as to what motivated you to write your second book, right? How to listen when market.
Okay.
What was kind of behind the genesis for that?
Well, I started off on the retail side of the business in the 90s, and as an advisor, I always felt I was getting information like second, third hand. And then when I went to Lehman Brothers, I was a trader there, and I saw the institutions would get a lot of investment ideas first, and then it would go out to more retail. And so we started this a Bloomberg chat and a Discord room in 2010, where we kind of like have a live conversation, like it's like a lens on a buy side conversation where we're talking with buy side investors. And now all that means is hedge funds, mutual funds, and pension funds about what's happening during the day, about new themes, about new narratives that are coming up in the market. And what I've noticed is that when new narratives come in, they come in first into what I call the buy side community, and then you see it in sell side research, and then you see it in Barron's and things like that. So I noticed this cycle, and so when we put this book together about the markets, we wanted to democratize information. We want to help investors kind of figure out how things really happen behind the scenes, what's really going on behind the scenes. And so we sat down with David Tepper, David Einhorn, Charlie Munger, some of the great investors, and how to listen when markets speak. It's been a good book for this year because it's all about. The bottom line is, if you can remember one thing like from this conversation, why we did the book, the fiscal and monetary response to Lehman Brothers was $4 trillion. The fiscal and monetary response to COVID, the regional bank crisis of 23, and then the juicing of the fiscal into the election was 16 trillion. So it's, 4 versus 16, 4 versus 16. So how that's going to play out in markets over the next year in terms of rotation out of kind of financial assets into hard assets, into commodities, that's kind of the main thesis of the book.
Yeah, when I went through it, I picked that up, and there's been obviously many pundits and experts alike that have talked about like when does this break, right? Like how do you just keep kind of artificially engineering your economy with all this money, and at some point, like when does it snap? And obviously, what do you do to position yourself? What to your mind, like through the book and just looking at the markets and the environment now, like can you pinpoint one giant blind spot? Is that it, the blind spot? People just aren't considering that? Or is there another massive blind spot that people just aren't aware of that we're all going to go back and go, like, how did we not see this coming?
Well, to me, the passive thing is the biggest blind spot, where I got this idea from a famous billionaire client. He's in our chat. So we run the Bloomberg chat here on with hedge funds, mutual funds, and pension funds. And I've been hearing this narrative over the last year, and it's so when passive goes from say 50% to 55, or even once every percentage above 50%, it gets more and more evil because the the funds that are passive they hold those stocks at BlackRock, Vanguard, State Street, right? So those shares are never going to come for sale unless there's a crisis, right? But a small cabal of hedge funds can juice, like there's really, if you think of like Costco, like what's the true float of Costco, or what's the true float of Walmart, or Facebook? If the company's doing a buyback
Mhm.
and then you have normal passive inflows, there aren't really that many shares for sale. So a small cabal of hedge funds can push these stocks up. And and then once that happens, the active managers, the Fidelities of the world, they have to chase. They're forced to chase, right?
Right.
So what's been happening is this group of funds has been juicing, the top 20 stocks. It's called index arbitrage, and they go long these stocks, the Walmarts, the Costco's, the Facebooks, and they go short the index, and they just juice. And there's really no. It's fascinating. Like when I was growing up in the business, you look on Bloomberg or you look in financial statements, and you got a feel for what's the true float of a stock, like how many shares are really trading. Today, that float is, I think, really, really tiny relative to potential demand. And what happened in the last month is that at least two of these index arb funds blew up, and we can get into the trigger of that. But behind the scenes, we think maybe 15 of them blew up. And so imagine like 15 to 20 different funds all playing this game and juicing stocks that really don't have any float. You can push them to, that's why the valuation on Walmart was so obscene relative to historical references. And then when you look at the shares of stocks that are not tied to the indexes, so if you look at Walmart versus say Dollar General or any retailer, like it's the divergences are something we've never even remotely seen before because of this, I call BS, like strategy of index arbitrage, where they kind of just juice those 20 to 30 names beyond, where they should have been.
Do you think that just the sheer mass amount of investors, everyday people like myself who are just mindlessly buying in the 401k plans all over the United States too, like is that part of that just keeps giving some sort of support to this market, even though like a lot of things you just pointed out are big problems?
Yeah, well, it's like we've seen this in our careers, right? Nobody cares about a problem until there's a controversy. And when everybody's making money, certainly nobody's going to care, right? I find it very fascinating that I was watching Tucker Carlson maybe a little while ago, and The Wolf of Wall Street, right?
Yeah.
He's found religion. Like this is like one of the bad actors on Wall Street. This guy's found religion in passive investing. Like, oh, you just got to own the index. You just got to own the index. That's all you have to do. And so that tells you like how penetrated that thesis is. Like everybody is just long the index. Everybody wants to be along the same 20 stocks. And
Right.
everybody thinks that's the thing to do. And yeah, the awareness of this is starting to break down.
But nobody has really, it's tough to have the courage to get on the other side of the boat, right? And be wrong for a while. And
Right.
you wrote this book a year ago, and the markets really haven't rolled over, but and who knows if this will be quick or not, but I think it's interesting. And you brought up long-term capital management, and I was just getting in the business in 98 when the Asian flu happened and that unfolded, and I loved reading that book, I think it was smartest guys in the room, or I can't remember, but long story
Yeah,
short,
when genius failed, that was a
when
good one.
Genius Failed, that was it. Yeah,
Yeah.
I love that. Was that a Michael Lewis one? I can't remember, but that was similar, right? Like they were doing an arbitrage. They weren't actually making a lot on the spread. It was that they were using so much leverage to do it, and their system was brilliant. And actually, had they been able to wait, in the book, it explains it. Could they have stayed in the trade long enough? It would have been great, but they couldn't, right? And then everyone were like piranha and went after them, and the whole thing that this one hedge fund took the market down, right? People forget about that. But in some respects, that came to mind when you were just talking about this arbitrage of the index, right? It's kind of in the same zip code, no?
Yeah, and our point in the book, like Neil Ferguson, I think he's probably the most impressive financial historian ever that's ever lived. his point was he wrote the forward for our book, When How to Listen When Markets Speak. And he's like, Larry's not one of these perma bears. What we're trying to say is there's 20 in February, there was 27 trillion in the NASDAQ 100. So think about this, 27 trillion in the NASDAQ 100. 10 years ago, maybe a little bit more than 10, it was about 4 trillion. So we went from 4 trillion in the NASDAQ 100 to 27 over the last 10, 11 years. Now, the oil market, for example, like think of like the XLE, different portfolios of oil stocks in the market, like the S&P 500 oil index, oil and gas. You're talking like 10 years ago, there was maybe 2.3 trillion in the oil and gas sector. Now it's a little bit more, so I'll call it 1.6 trillion. So the oil names have gone from 2 points, call it 2.6 to 1.6 trillion. And the NASDAQ 100 went from 4 trillion to 27 trillion. So it's not going to take much. Like you think about ExxonMobil and Chevron are only 20, as of like last week, we're only 29% of NVIDIA's valuation, right?
Right.
So it's not going to take much. And that's what Ferguson's point is. Larry's not like, we're not a perma bear. What we're saying is this great migration of capital as investors, like right now, the oldest baby boomers are turning 79, and there's 79 trillion of wealth in that group. So that's a great stat from the book. The oldest boomers are 79, and there's 79 trillion of wealth in that group. And so it's not going to take much to trigger this kind of great migration from growth over to value and toward companies that actually own hard assets in an elevated inflation world.
So, oh, yeah, let's dive a little deeper. Right now, people are obviously recessions come up a lot more. Stagflation seems to be something that's kind of on everyone's mind right now. And credit spreads really haven't done much. They've been really tight. And they're obviously widened out a little bit recently, but nothing crazy. Like the bond market, a lot of experts have always said, like, that's my best indicator. Like I look at the bond market, that's really where I figure out kind of what the market's thinking. How do you look at that? Like your clients must be asking that question, and like, do you think stagflation is something people should be positioning for? What are your thoughts there?
Well, in credit, what we noticed was in the 2024 bull market, to your point, credit spreads were grinding tighter, but triple C's, which are the junk of the junk, they were kind of outperforming equities. In other words, they were really strong relative to equities. Over the last month, for the first time, the triple C, even to your point, that the credit spreads overall have been relatively tight, especially relative to historic standards. But the triple C's are the kind of that leading indicator. They've been leaking some oil, right? So that's a great leading indicator for investors. We talk about that in the book. And then the other, I think the big tell has been the tertiary financials. And what I mean by that is companies like Synchrony, Affirm, OneMain, companies that are in the financial sector, but they're exposed to subprime lending, right? Those have been massively, massively underperforming the XLF. And so there's this like basket of indicators that if you're in a fiscal contraction mode in Washington, these indicators mean a lot more. If you're in a fiscal expansion mode in Washington, you got to be careful with some of these indicators because, as we saw in 24, Biden juiced the fiscal into the election and the economy just kept humming along.
So let's shift a little bit to our listenership right now. You obviously wrote this book and you talk about this long-term sort of narrative around what we're seeing and how it's going to play out. But for advisors, they have to deal with the day-to-day volatility and their clients. And you as well obviously have clients. So I'm sure you were busy as all get out yesterday. People kind of what does this meltdown look like? Um, like what would you suggest to them? Like what's the best way to listen to the market? What are the other, would you kind of put it into like three or four things that you should just really kind of have on your radar and just block out all the other noise and the pundits on CNBC? Like how would you recommend advisors kind of manage the noise for their clients?
Well, I think new lows on the New York Stock Exchange. We talk about that in the book, but when you see those new lows get up, above 1,000, historically, the last 20 years, it's always been a great time to buy, right? And get more, and you know, raise your exposure to the market. Um, there are other indicators that you want to look for. Okay, like what sectors are outperforming versus the market. What sectors are more washed out? Like we're looking at capitulation right now. The XBI biotechs, for example, we're getting a category five. Like to get a category five capitulation signal in our model, it takes like we had it with oil stocks in 2020. We had it with some of the uranium names, 2020, 21. Uh, we're picking up a category five, like where your max seller exhaustion, very similar to Chinese equities last year. There was a category of 4.5, 5 in September and December in Chinese equities. But yeah, you want to look for really when that max seller exhaustion level has been reached. And right now, I think if you buy, say, biotechs in the XBI, um, your value there, your risk reward is very attractive because all the signals point toward like a massive, massive capitulation that has reached peak seller exhaustion.
Interesting, interesting. So to pull the lens back a little bit, the 60/40 portfolio has been something that's just been a ballast for investors since, I can remember, and I'm sure you. There was a lot of shade thrown towards it, especially 2022 was a horrible year for a lot of the markets, right? Um, how do you think about that? Do you think fixed income is going to come back? I know yields are better now, but we've got inflation. Are you talking to clients about that 60/40 sort of allocation is antiquated? How do you look at it from your vantage point?
Okay, yeah, that's one of the most important things today. It's the 60/40 portfolio in a disinflationary world where lower inflation, disinflation is very, very, very certain. The 60/40 portfolio is going to work great. In a multipolar world where you have global conflicts, trade, tariffs, um, higher interest rates, more stagflationary, like a 1968 to 1981 environment, that's where you need to be almost like 35, 35, 35, 35% stocks, 35%. 35, yeah. So you want to have at least 20% in 15, 20% in commodities in that kind of world. So think of like from 1968 to 81. By 1981, 49% of the S&P 500 was in materials, industrials, oil and gas. 49%. And that's because you were in that kind of like sticky inflation, slower growth environment.
Right.
And the DCF model, which we call discounted cash flow model, that model, when you're in that kind of environment, the valuation of companies that own assets, they become more valuable with a higher risk-free rate. And so with a low risk-free rate, treasuries, growth stocks are, and that 60/40 works wonderful. Um, in 22, to your point, we kicked off kind of this new world, which is more stagflation, higher interest rates. The Fed tried to put out the fire, and everybody kind of went back to that 60/40 portfolio because last year growth did great relative to value. But it's very clear that because of tariffs, because of the Fed kind of they really didn't allow the recession to come. So they eased 100 basis points, and they just basically created an environment of much higher sustained inflation. And we're going back to that 1968 to 81 world. I don't think we're going to be 49% of the S&P 500. It's not going to be materials, industrials, and oil and gas. But are we going back to it? Right within the last year and a half, 2 years, we were down at 14% for those groups. So think about it. They went from 49
Wow.
to 14 to maybe even 12. I think at one point it was like close to 12. Are we going back to 25, 30% for those groups? Materials, oil and gas, and industrials? Yes.
Well, that's great insight. So taking that a step further, you mentioned commodities, and certainly we've seen just a dearth of capital go into the private markets, and especially in the private wealth management side of the business, the financial professionals listening, their clients. We know Blackstone jumped in and just, changed everything with their B REIT and their B cred products. Do you think that that is something that is an intelligent way for investors to allocate capital in the retail market, or do you feel like you're maybe better off sort of just sticking with commodity type products and things like that? Or like, how do you look at that? Because you've got I know that's a big question. You've got private infrastructure, real estate. There's all ways to do private markets, but just
Yeah.
from 40,000 feet, how do you think about it? What would you say like to clients in terms of this? This is a big conversation right now, right? It's like American exceptionalism. We've had the best markets. We've kicked everyone's butt for as long as we can remember. Now you're seeing a first quarter that finally saw European markets really show some life. And obviously China is trying to do everything they can to get things going there because they've had some troubles with real estate and other things. Do you think this is a time to make a big shift? Like, is this a long-term sort of secular trend, or is it still going to be another 2 or 3 decades or whatever of you have to have a heavy allocation to US equities long term?
So yeah, the EM trade is like very cyclical. Like if you've been in EM for 20 years, you pretty much didn't make any money, right? But it is very attractive in certain counter trend situations like we are in now. So for the next like 3, 4 years, like Brazil has an election coming up October 22, 2022. You've got a potential, I'm sorry, October next year, October 2027. So October 2027, there's an election coming up in Brazil. And I'm sorry, October 2026, excuse me. So next year, you've got an election coming up in Brazil. Brazil equities are still like maybe 12 to 13 times earnings. And they're very cheap. There's a high commodity component to that economy. And we're seeing a lot of institutional investors buy Brazilian equities for like a 3 to 4 year outperformance swing versus the S&P. Like I said, you've got Lula is a very socialist, market unfriendly president, and if you had a Malay type situation in Brazil, a lot of investors missed the Argentina run, right? A lot of investors. So I think there's going to be a lot of front running if you can get a market friendly candidate in Brazil over the next year. People are going to run. A lot of times, stocks will run up. Like think about the S&P was up 55% into the Trump win, or I guess you can have to count the Trump win into that, but it was up a lot into the Trump win. I think maybe 60%. So the market prices in market friendly candidates a lot of times. Like look at Reagan. The market was up, I think, around 50% into Reagan. The market went nowhere for 2 years, and then
Yeah.
really did well in his last 2 years. So Brazil, do we run into that? Yeah, you want to start looking at EM down here because it's at the end of the day, the S&P is trading at 24 times expected earnings. Europe's more like 15, 14, and EM's parts of EM are down at 12.
Right. And obviously the thinking is the US with this position of kind of isolation, economics, what have you, is pushing Europe to spend more and to do more, right? We saw that with Germany approving the $1 trillion and on all those things. So a couple of questions before we wrap up. Just shifting off the sort of specifics of the markets for your listeners and everyone. You've covered so many great investors, and as you mentioned, you work with a lot of them. Who's the investor or kind of modern day investment thinker of our time right now that you admire most right now?
There's no question, hands down, it'd be David Einhorn because he's the perfect investor for right now because he's a value investor. And so he only will buy companies when they reach, the most. So he's like Buffett, but he's very good on the short side in terms of like shorting companies that are overvalued. So to hedge your longs, he's probably the best at doing that, I think, in the value space. Whereas Buffett, he hedges his longs with cash, right?
Right.
Which is a great way to hedge longs. But David, uh, David's coming into a period like, and I said this in 22. In 22, I said this. He outperformed the market by I think 36, 37%. In a 1968 to 81 type of world, guys like David Einhorn and Greenlight Capital are going to really crush the market.
Interesting. Okay, to close, for our listeners, a lot of them financial advisors. Is there one specific piece of advice you would give them in terms of how to just guide their clients through the next 12 or 24 months?
You know, you want to buy fear, right? And so, but you want to like what's really worked the last like 10 years is just sitting in the boat and waiting for those moments of real peak fear. So you look for percentage of stocks above the 200-day moving average. Historically, when that gets around, 5 to 20 to 25% in there, the percentage of stocks below the two, above the 200-day, that's something you want to look for. But yeah, just the patience to put money to work when there's real fear. And the sell side research will try to get people to chase rallies. And a lot of times, that chasing is good in a momentum bull market, but in a choppy market, you're much better off sitting in the boat waiting for real fear like this and putting money to work and just waiting for that real capitulation moment.
That's great advice, Larry. Thank you so much for coming on the show. I wish you so much success with your book that's been out a year now, How to Listen When Markets Speak. Obviously, Bear Traps, your publication and your business is doing exceptionally well. And unfortunately, these are times when you probably do your best because this is when people are really looking for your insights. So thank you. The next time you put a book up, we'll love to have you back on, but we really appreciate having you on the Advisor Lab.
Thanks. And as a former Lehman trader, I tell my wife, once a month or so, if we sell 1 million books, we'll break even on our Lehman stock. So we appreciate you having us on.
This video is for informational purposes only and should not be considered or relied upon as investment advice. It may not be copied, quoted, or referenced without Cyan Investment's prior written consent. Do not rely upon any opinions, predictions, or forward-looking statements contained herein. The views expressed do not constitute an offer to sell or a solicitation to purchase securities, nor do they constitute the endorsement of a particular asset class or investment strategy. Neither Cyan Investments nor its affiliates and/or subsidiaries warrant its completeness or accuracy. Certain information contained in this video may constitute forward-looking statements that may be inherently unreliable, and actual events or results may differ materially from those reflected or contemplated herein. Cyan Investments expressly disclaims any obligation or undertaking to update or revise any information included herein. The views expressed by the guests or participants are their own and do not necessarily reflect the views of Cyan Investments, LLC, or any of its subsidiaries, officers, or staff. Please be aware of the real risk of loss in following any investment strategy. No investment strategy or asset class referenced herein is intended to be construed as investment advice. You should make an independent, informed decision regarding any investments or strategies only after reviewing all relevant offering or disclosure documentation with your financial professional, and after considering your objectives, risk tolerance, and best interest before making any investment in any financial product. Registered personnel should review any business development initiatives addressed herein with their respective compliance and legal departments. Coverage of such topics should not be construed as compliance or legal advice. It is at the discretion of each respective firm if such practices are consistent with firm policies and procedures.